well, it's 3,300 now. What makes it go to 10,000? What makes it go to 20,000? I don't think 10,000 or 20,000, I think there's that much of a difference, because once it goes to 10, it'll go to 20, it'll go to 50, it'll go to 100, and then it'll just go to infinity. I mean, the final stages of these processes are very quick, and they always are. What causes that? I think the next round of QE, followed by the last round of QA started in 2019. It really took off. It's September 2019 it started, and it took off around COVID, which might have been an excuse to add more money. It might have been planned. It might not have been planned. It might have been something in the middle. I don't really know. But I think we're going to see something similar at the beginning of another round of QE, which I think will bring gold up to maybe 4,000, 5,000. And then banks will start getting in trouble, and they'll just start printing more and more and more. And then it'll just start going vertical, and that'll be the end of the story.
Once gold reaches $10,000, it will likely continue to rise to $20,000, $50,000, or even higher in a rapid parabolic move, a new cycle of quantitative easing, QE, similar to the one that started slowly in late 2019 and intensified during the COVID-19 pandemic. They anticipate a similar round soon, with gold initially rising to $4,000 to $5,000. As financial stress worsens and banks fail, central banks may print excessively again, causing gold to surge in a last explosive stage. Financial analyst, investor, and author Rafi Farber is well known for his in-depth knowledge of Austrian economics, precious metals, and monetary economics. He says that leveraged basis trades, which take advantage of minute price fluctuations in Treasury markets, account for the majority of the almost $3 trillion that exchanges hands between banks every day. These transactions rely on bank reserves, which the Treasury will deplete to finance government expenditures if the debt ceiling is increased. This would cause a sudden shortage of liquidity in the repo market, forcing many trades to be unwound and potentially leading to a market crash. The Fed will intervene with additional quantitative easing to avert catastrophe, which might ultimately devalue the dollar. Large cash reserve banks such as JP Morgan lend money to the repo market, allowing other banks to finance leveraged Treasury trades. Although this isn't quite a debt monetization, the Fed creates more dollars by putting them into circulation, usually by purchasing assets like Treasury securities and essentially backing them up with the assets it purchases. As a result, the dollar is supported by government debt that promises to be repaid in dollars, creating a precarious inflationary cycle. To prevent collapse, the system must continue to grow. The dollar might collapse like a black hole if it doesn't, forcing people to return to using gold and silver as actual currency. Gold remains the most widely accepted and reliable form of currency on a global scale. According to Rafi, the US dollar became the world's reserve currency primarily by accident, particularly after World War II, when nations exchanged their gold for dollars that were safely stored in New York. Because of this, the United States was able to create the appearance of riches by running enormous trade deficits, which amounted to exporting dollars, debt, in exchange for actual products. But this is not a sustainable system. These dollars kept abroad will eventually return to the United States, reversing the trade trend. That will cause economic anguish, rob Americans of their easy prosperity, and force them to either produce again or suffer severe suffering. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
So what's happening is $2.8 trillion changed hands yesterday. And today it's going to be, I think it's going to be a new record because we're on June 30th, and record amounts of money change hands between banks on month ends. And this is a quarter end because I think this is the end of Q2, June 30th. So I'm betting we could see 2.9 trillion, maybe even $3 trillion. Now, the question is, where do those dollars come from? And the answer is they come from bank reserves. And why are they changing hands? Well, there's a whole bunch of bets that are being placed every single night in the using repo dollars, using these dollars that change hands between banks in order to place bets on Treasury futures and then sell the futures and buy the spot and whatever it is. It's like these stupid trades where banks get a cent or two per trade and then they multiply it 50, 60 times and they end up with millions of dollars free money every night doing this. So if we have $2.8, $2.93 trillion changing hands every day, and we only have about $3.3 trillion in reserves, that's not a big buffer zone. So the minute that the debt ceiling is raised, that means the government or the Treasury is going to have to suck dollars out of those bank reserves and then spend them on a bunch of crap. And then there will be fewer bank reserves and fewer dollars to change hands. So all of those banks and hedge funds or whoever's doing it that are making those penny trades and multiplying it 50, 100 times over, if they run out of money in the repo market, those trades all have to close at the same time because they can't be funded, and then you have a crash. So once the Treasury, here's the crux of it, once the Treasury has to raise more money by adding to the debt and sucking bank reserves out of the system, there's not going to be enough dollars for the repo market to fund the basis trades that are happening every night. And the Fed is going to have to invent the difference. That's quantitative easing. There's no step down method of these huge trades. Once they build and build until they crash, which is what happened in 2019. And it's going to happen again shortly after the debt ceiling is raised, which is whenever this big, beautiful bill is passed, which has, pornographic connotations to it, thanks to Donald Trump. And it's going to be the end of, the end of something. It's going to be the beginning of the next quantitative easing round. And from there, I think the dollar is going to be destroyed shortly afterwards. Could I be wrong? Yeah, I could be wrong. There could be some kind of other rabbit that I haven't counted, but I don't see it. I don't know if it's monetization of debt. I'm just saying that there are some banks that don't have cash, and there are some banks like JP Morgan that have a whole bunch of cash. So let's say JP Morgan lends out its cash to these other banks so that their clients can borrow it through the repo market and then use it to fund Treasury futures trades. I'm not talking about monetizing any kind of debt, but in order for the dollar supply to be added to, how it's done is that the Fed buys treasuries, because they could buy anything. They could buy my chair. They could buy, Harry Potter books. It doesn't matter. As long as those dollars are added to the system, it doesn't matter what they buy. And then the dollar becomes backed. The word we use is backed by whatever assets they buy. If they buy my table, if they buy my couch, then the dollars are backed by the value of my table and the value of my couch. It just so happens that when they buy treasuries, the dollar becomes backed by the asset that they're buying. Like, the dollar is a liability unit. A liability unit has an asset on the other side. The asset on the other side is mostly treasury debt. But treasury debt is the promise to pay those same liability units in a circle. And so you have an inflationary loop that if it doesn't keep expanding, it collapses in on itself like a black hole. So you have like what we're, the situation we're in, I guess, astronomically, is a neutron star, where you have a star that's just dense enough to maintain its volume without collapsing into nothingness. But if it gets any more dense, it just collapses in on itself, and there's a black hole, and then it disappears, and you have an infinite density unit called singularity, and that's where we're headed. So what happens after the singularity? The dollar goes away, nobody uses it anymore, and we have to go back to what money actually is, which is gold and silver. Credit goes away. When credit goes away, money goes higher. The dollar is credit. It's not money.
No, absolutely. All else is credit, right? Gold is the only form of money. All else is credit, is the famous saying here.
It's not the only form of money. I'm just to be a little bit nitpicky on that. It's not the only form of money. There's no singular form of money. There's no one thing that's money and another thing that's not money. Money is a continuum. It just has to do with degrees of liquidity of whatever commodity. So the best money is the money that's the most liquid in a given economic system. If we're talking about a prison, it would be tins of mackerel or cigarettes, because that's the only thing that's allowed in there. But if we're talking about the entire planet, then the most liquid commodity between nations is gold. It just is. For whatever reason it is, it is. So world reserve currency just means it happens to be through historical accident that America took over the world. And on that opportunity, once they won World War II, they went to all the financial centers of the world and said, look, here, give us your gold. Even before World War II, they did this. They give us your gold. We'll store it here in New York so the Nazis don't, invade your country and take it. And then we'll give you dollars and you can use those. So everybody has dollars. And what does that enable? That enables like a huge inflationary pot, right? If you have more people taking your inflation through trade deficits, like everyone complains about the trade deficit. Trump complains about a trade deficit, but a trade deficit is the only thing that is keeping the dollar functional. Because what is a trade deficit? It's when America exports a whole bunch of dollars, which are backed by debt, and they get them out of the country, and in exchange for all those dollars, they get stuff, right? So you're importing more stuff and you're exporting crap. So that's great. If I had a printing press and I could just print out, pieces of paper and import a whole bunch of stuff into my house and have a trade deficit, I'd look really freaking rich. That'll be great. But then eventually people would call in my debt, and then I wouldn't be able to pay them. So they'd take all my stuff from me because I couldn't pay. So that's what's going to happen. So the world reserve currency, it just increases the inflationary pot that America can skim off of, and that makes it a lot longer lasting. But it also makes the eventual, knocking on the door with the repo guy coming and saying, "Give me your stuff." It makes it all that much bigger in the end. So yeah, we just experienced the biggest several decades, let's say 50 years of humongous, insane prosperity for all Americans who basically didn't have to do anything in order to survive. And now once this is over, the trade deficits are going to reverse. They're going to become humongous trade surpluses, which are going to bring all the dollars back into America, yay, in exchange for for all the stuff that they imported. And then everyone's going to be poor, and they're going to have to figure out how to work again or die.
When compared to gold, the stock market's apparent long-term gains appear to be a mirage. Gold has outperformed stocks in real terms since 1971, maintaining its purchasing power more effectively than the S&P 500. The speaker anticipates a similar surge, possibly a 79x gain in gold's value compared to the S&P, which would result in a significant shift of purchasing power from stockholders to gold holders. According to them, the US dollar, DXY, is limited because it can disrupt international trade if it depreciates excessively and could cause a banking crisis if the Fed tightens to maintain its value. They contend that either course leads to the demise of the dollar, either through systemic collapse or hyperinflation. Rafi argues that silver is the people's money, unlike gold, which functions primarily within the banking system. Due to its weight, central banks do not typically hoard silver, but they may do so if public confidence in the currency declines. The monetary demand for silver may become practically limitless as a result of this change in demand. The speaker thinks we will return to the historical 15-to-1 value ratio between silver and gold, which would suggest that silver would increase far more quickly than gold. Additionally, above-ground silver reserves are being depleted by industrial use. Should these run out, prices may rise sharply. Given that the dollar has historically been based on silver, this could cause its value to plummet. Before a new credit system is established, people may use silver coins to purchase assets such as homes and cars after the price of silver spikes. Now, let's dive into the interview.
The ratio of gold to the S&P 500 is lower than it was in 1971. So the real value of stocks is lower. Like if you took 10 ounces of gold and stuck it in your mattress in 1971, you'd have more purchasing power now than if you took the S&P 500 in 1971 and stuck it in your portfolio. You'd have more purchasing power with gold, which means the entire rise in the S&P 500 has been a chimera. It's been an illusion. It's not even real. But in 1980, what am I looking for in terms of price signals? In 1980, I think the S&P 500 was the high for the ratio of gold to S&P was, I think, 0.4 or 0.53, if I remember the number correctly. I don't remember exactly what it is. But whatever it was, it's like 78 times what it is now. So, but that only took that from 1971 to 1980, and really from like 1976 to 1980, in those 4 years, that's when that huge spike happened. So that's what I'm looking for, a rise of about 79 times in the value of gold versus the value of S&P, which means that everyone's purchasing power who has mainstream stocks will be cut into 80 pieces and they'll get to keep one, whereas everyone who has gold right now will suck in all that purchasing power, and that will be the end game. And silver even farther than that. I think it was silver that was set. That was 80 times. I think it was gold that was maybe 15 or 20. Sorry, I'm mixing up the metals. But in terms of the Dixie, truth is I don't even follow it because the Dixie, the dollar index can't swing too far in either direction because it disturbs trade relationships. And once you disturb trade relationships too much, then exporters from some countries get upset and importers from other countries get upset, and they have all the political power because they control the economic spigots of the country, what's imported, what's exported. So when the Dixie gets too weak, the Fed has to slam on the brakes, which they'll have to do. But if they do that, they cause a banking crisis. So we're getting into that territory where they have to pick if they want to maintain the dollar strength or they want the banks to survive. And once we hit a corner there, it's just going to explode. It doesn't really matter because once they get to the corner, whatever way they turn, the dollar is going to die. Either it dies because they give up, and then all banks collapse. All banks, not just some banks, all of them, because they're all connected. And then if that happens, you have a bunch of very unhappy bankers, and you don't want to deal with that, and very unhappy people who don't have any deposits anymore, and they don't have any money, and then you have to start riots in the big cities. Or they print, and then the same thing happens anyway because the dollar is worthless. Once you have that binary, you go either this way or that way, and either way, it's the same thing. Silver is the public's money. Okay, so gold functions as money for banks. They don't have any, they don't have any in their vaults except for maybe J.P. Morgan or something. But what they have is futures contracts, which are theoretically connected to the physical supply. So silver is not silver. Banks don't deal with silver. Central banks don't have silver. It's too bulky. Silver is the people's money. So when people start to figure out that their dollars are losing purchasing power, they can't necessarily go to gold. So they go to silver, which means that the monetary demand for silver becomes infinite. It becomes for, people need food, they need water, they need energy. But in order to acquire all those things, you need money, or else it can't be distributed. So famines, for example, are usually not due to a shortage of food. They're due to a shortage of money, because if you don't have money, you can't distribute the food. You can't tell where the demand is, so it just like rots on trains. If you read the book Mao's Great Famine, which is the greatest famine in the world from 1958 to 1962, it wasn't because of a lack of food. It was because the money didn't work. And and Mao's whole regime was controlling the entire, not because there was hyperinflation, but because monetary exchange was outlawed, and like everything was in the hands of the Communist Party of Mao to decide which food was going where, and they couldn't decide because they didn't know. So then all the food rotted. So that's what happens when you don't have money. So when the dollar no longer works, everybody goes to silver, and that reestablishes the historical monetary ratio of around 15-1 of gold to silver, which is where it was before 1873, when the silver price, when the dollar was a derivative of silver and gold by metallic standard. So we'll go back there. We'll go back to 15-1. That's an oversimplification. The industrial side is important. It's not as important as the monetary side, but it's important because silver is a byproduct of mining. It's not really a primary product. Like the silver supply that we have is due to mostly, let's say, copper miners or lead miners or zinc miners. And then they mine a lot of zinc or a lot of copper, a lot of lead. Not that, maybe 5-10% silver. And so they sell the silver no matter what the price is. Since the price is so low, there's not enough silver being mined as a secondary product to satisfy all the industrial demand. So what will end up happening is that we're seeing silver inventories get lower and lower and lower as industrial demand takes up the silver inventories that are already above ground. And once those are zero, then you have a slingshot move. And what I think is going to happen is that's going to contribute to the rise in the price of silver. And the rise in the price of silver means, by definition, the destruction of the price of the dollar relative to silver. And since the dollar is a silver derivative, it was in 1873, therefore it still is now, not statutorily. I understand that it's not a statutory derivative of silver, but because the dollar was born out of silver, it still is a silver derivative. So if the price of silver is triggered to rise very quickly because the inventories that are being sucked out of these big safes or these big vaults, if they go to zero because of industrial demand, then that triggers the hyperinflation, the same hyperinflation that we're talking about from a monetary perspective, from an industrial perspective also. These are all different ways to look at what's happening, different angles at the same result here. So when that happens, it could be a catalyst, it could be a secondary cause, but it's going to happen. And then silver is going to go to 15-1. I think it's about 95-1 now. So silver should rise about 5 times faster than gold in dollar terms. And that's where most of the gains are going to be. And once it hits 15-1, buy whatever you can with your silver coins directly, like hand people silver coins and say, give me your house, give me your car, give me your business. That's how it's going to work for a little while until credit is reestablished. That's what we got to be prepared for.
The entire scenario paints a vivid and urgent picture of an impending monetary reset in which unrelenting central bank intervention, fragile banking systems, and unsustainable debt would erode the value of the US dollar. He contends that gold and silver in particular will regain their historical roles as legitimate forms of money once the fiat system breaks down. Farber cautions that the final explosive phase is approaching and that those who are unprepared may lose everything measured in fiat terms as the public turns to silver as the people's money, and gold may go parabolic during the next QE cycle. How can people best get ready for a sharp decline in the value of gold and silver if the new round of QE starts soon? Could silver's role as the people's money make it even more valuable than gold in the coming monetary transition? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.